Hello everyone, I'm John with JP Strategic Investments, and today I'm going to address a common point that is often brought up by investors that are bearish on Rocket Company stock, and that is that interest rates are the only thing driving Rocket's growth, and that once interest rates start to rise, Rocket's revenue will decrease dramatically. This is an argument that I've seen a lot recently, and so I wanted to address it and go over exactly how much a rise in interest rates would affect Rocket's business and what other growth vectors that Rocket has that could offset some of these losses from rising interest rates. So let's dive right in. So the first thing I wanted to go over is how rising interest rates could affect Rocket's business. So the main idea behind the argument that I mentioned before is that low interest rates drive refinances, and since refinances are the bulk of Rocket's business, rising interest rates will reduce the main source of Rocket's revenue. This argument does have some truth to it. Generally, refinances do decrease as interest rates rise, so a decrease in refinances will decrease the amount of loans that Rocket originates. But the question is, how much will it decrease this amount? Conventional wisdom says that the decrease in loan origination volume from Rocket will decrease by the same amount that it increased when the rates dropped. Or in other words, if rates go back to say 4%, then Rocket's loan origination volume should go back to what it was when rates were at 4%. But there are several reasons that this won't actually be the case. First of all, Rocket has the best refinance recapture rate in the industry by a huge margin. This means that the more refinances that occur, the more customers Rocket steals from their competitors. This is evidenced by their steadily increasing market share, which is almost at 10% and still has substantial room to grow. Rocket's CEO has said that the company's goal is to reach 25% market share of the mortgage origination industry by 2030. This means that even if rates were to increase, the extra market share captured by Rocket would be able to offset most or all of these losses from any decrease in loan origination volume. Not only that, but this gain in market share should be accelerated by the continued surge in refinances as I mentioned above. Another thing to keep in mind is that refinance volume will likely continue to stay high even as rates begin to increase as a result of pent-up demand for refinances. Currently, there are roughly 19.4 million homeowners who are considered high-quality candidates for refinances. This means that they could shave more than 0.75% off their current rate by refinancing, and that's not including the 6.4 million homeowners who have already refinanced in 2020. That means there's more than enough demand for at least 2 more record-breaking years of refinances if rates continue to stay low. And even if rates slowly rise, that demand won't just go away. We can see from the chart here that even when rates were at 3.5%, there were still almost 11 million high-quality candidates for refinances. Keep in mind also that many of these people may not have been able to refinance in 2020 because they either lost their job or had other economic hardships that prevented them from being approved for a refinance. As the economy recovers, this will create a steady flow of people looking to refinance even if rates rise above the 4% mark. Lastly, we have to remember that it's very possible that Rocket's gain on sales margin could be even higher by the time rates rise, meaning that Rocket will be able to make more money off of each loan originated and sold, even if they're originating less loans. So as far as how a rise in interest rates will affect Rocket's business, I would say as long as the rise is gradual and Rocket is able to continue to gain market share, then the effect should be very minimal. Now add on to that the other growth vectors that Rocket is pursuing through their other segments, and it's easy to see that the gradual rise in interest rates will not stop Rocket from growing. First of all, Amrock, which is one of their subsidiaries that provides title services, property valuation, and settlement services, facilitated over 444,000 settlement transactions in 2019 and was the main contributor to Rocket's other income section, increasing by over 140% year over year in Q3 of 2020. Second, Rocket Homes, their home search and agent referral platform, is growing quickly and posed to grab a nice slice of the point-of-sale real estate market, which is currently valued at approximately $100 billion. Rocket Auto is another growing segment which facilitated nearly 20,000 used car sales in 2019 and also has more room to grow with over 40 million used car sales recorded in 2019 alone. Rocket also has a variety of other segments, including its investment in Edison Financial and acquisition of Lendesk, which are 2 Canadian companies. Rocket believes that they can leverage the same technologies and strategies they use in the US market to take advantage of the Canadian mortgage origination industry, worth over 760 billion Canadian dollars. All of these segments offer Rocket large growth opportunities that should far outweigh any possible short-term losses from rising interest rates, and Rocket has the ability to leverage their large mortgage platform to market these platforms to existing Rocket customers in a very similar way that Uber is able to leverage their ride segment to market their other services to existing Uber customers. This will accelerate the growth of these other segments and greatly reduce customer acquisition costs. So to sum up everything here, I believe that a gradual rise in interest rates over the next several years will only have a small negative effect on loan origination volume. And this small loss will not stop Rocket from continuing to gain market share on its competitors and growing their other segments, essentially meaning that Rocket's dependence on low interest rates is far smaller than many investors think. I hope you found this analysis helpful, and if you did, please consider liking and subscribing. Also, be sure to let me know in the comments below what you think of this analysis, and let me know where you think Rocket stock is going from here. Other than that, have a great day.